Welcome to Beyond the Comfort Zone Talking Shit with KING-KAMBUF. You are listening to our weekly analysis, the reserve of KAMBUF Financial News and Reports magazine, weekly market digest and investment analysis.
And this is the Week Ahead Report covering the trading landscape as we head into December. It is Sunday, November 30th, 2025.
The market's resting, but we are not. The stack of financial intelligence we got for this edition is absolutely massive.
It really is.
So our mission today, I think, is one of the most critical we faced all year. We have to take this entire document, the executive market summary, the earnings calendar, those super detailed T-KIFE technical charts, all of it, and just distill it.
Pull out the crucial nuggets.
Exactly. Give you, the listener, a total roadmap for the trading week that kicks off tomorrow, December 1st.
And we really need that roadmap because the market sentiment right now is complex. It's almost, schizophrenic.
Right.
I mean, yes, the U.S. market closed a really volatile November with clear positive momentum. That Black Friday bounce was real.
Sure was.
But when you actually dig into the data, the signals are not all pointing in the same direction. They're mixed, they're powerful, and honestly, they're demanding a lot of caution.
Okay, so let's frame that complexity. Because we're coming off a historic winning streak and heading right into, the final high-stakes month of the year. What's the overall tone we're walking into for December?
The big theme is resilience, paired with rotation.
Resilience and rotation.
Yes. The S&P 500 just logged its best week since June. It completely erased that mid-month volatility, and that gives us enormous positive inertia heading into December.
Okay.
But, and this is a huge but, there are these crucial rotation signals that tell us institutional capital is actively shifting under the surface. The most glaring piece of evidence.
The NASDAQ here.
The NASDAQ Q composite. It snapped its really impressive 7-month winning streak.
7 months. I mean, that's the kind of run that defines a bull market. So what does the T-KIFE methodology, that proprietary system KING-KAMBUF uses, what does it tell us about this shift?
Good question. And maybe we should quickly define that for anyone new to the reserves analysis.
Yeah, let's do that.
Sure. So when we say T-KIFE 20+ on, we're talking about a specific technical analysis system. It's the KING-KAMBUF indexed factor evaluation. And the 20+ just means it uses more than 20 different data inputs.
So it's not just standard moving averages.
Not at all. It's a multi-factor system. It combines volume profiles, proprietary momentum oscillators, sentiment indicators, all to identify these high probability setups.
The trades where the technicals and the fundamentals just line up perfectly.
Exactly. So that system is what flagged the NASDAQ Q streak breaking.
And what does that break actually imply? What does it tell us about the market's underlying health?
It implies that institutional gravity is shifting. It's moving away from the broad tech ecosystem. So our macro goal for you today is to pinpoint exactly where that gravity is pulling.
Right. Is it going into defensive assets, value stocks, or is it just getting more surgical within tech itself?
Precisely. And once we identify those gravitational centers, we can use the specific T-KIFE technical plays to capture the price moves. That's how you monetize the volatility.
Okay, so let's unpack this. Resilience and rotation. Let's start with the final numbers for November. The S&P 500, it finished the month up, just 0.1%?
Just 0.1%. And while that sounds modest, it was enough to extend its winning streak to 7 consecutive months. We closed Friday at 6,849.09, up over 0.5% on the day.
That 7-month winning streak feels way more important than the tiny monthly gain.
Oh, it's far more significant.
Right.
Historically, sequences like this, 7 straight positive months, they're really rare outside of a massive cyclical bull run. It signals extraordinary underlying institutional bullishness.
And liquidity.
Yeah. And when you couple that with the weekly performance, a huge 3.7% gain for the S&P, 3.2% for the Dow, that's just fierce momentum coming on the holiday.
It's undeniable momentum. But then we have to deal with the pivot point, the NASDAQ Q composite. It snapped its 7-month run. So for our listeners who are heavily in growth stocks, what does this rotation actually mean? Is it fear, or is it just people taking profits?
It's the single most critical signal we have heading into December. And it's primarily profit-taking, driven by valuation concerns, but with, let's say, a cautious flavor.
Okay.
The data strongly suggests institutions are de-risking from broad tech exposure. When the NASDAQ, the epicenter of high multiple growth and all the AI hype, fails to keep pace, it means money managers are looking to lock in their gains.
And move that capital somewhere safer.
Exactly. They're seeking refuge in less volatile areas or maybe alternative growth spots like healthcare or some specific industrials.
So it's not a collapse, it's a tactical recalibration. which means you have to be surgical inside the tech sector.
That's the perfect word for it.
Speaking of health and caution, let's talk volatility. The report highlights a big, almost startling drop in the VIX.
Yeah, the VIX, the market's fear gauge, it closed at 16.35. That's down a solid 5% for the week.
And a VIX in the mid-teens is generally seen as a good thing, right? Constructive.
It is, especially after a highly volatile stretch. It's usually viewed as a very constructive signal for directional traders.
But let me play devil's advocate here. Don't low VIX readings, especially after a huge run-up, sometimes come right before a sharp correction. I mean, isn't that peak complacency?
That is precisely the question you have to ask as a trader. A low VIX means current fear is low, but it can absolutely signal complacency, which is dangerous.
So how does the T-KIFE system guard against that?
It doesn't rely only on the VIX level. It uses the VIX to inform position sizing.
Ah, okay.
So when the VIX is low, like below 17, it validates using tighter risk management, like that strict T-KIFE -1% stop loss we talked about, because you expect price action to be orderly.
And if the VIX were, say, at 25?
We'd widen those stops, because overnight gaps become much more likely. But for this week, the mid-teens VIX supports the idea of an orderly continuation of the uptrend, and that's crucial for these high-probability plays.
Got it. So it's a practical tool for risk management, not just a macro signal. What about market breadth? Is this rally still just about the 5 or 6 megacaps?
Well, the megacaps undeniably dominate the index returns. That's just the math of market cap weighting.
Right.
But the technical readings do suggest participation is improving. We're seeing mid-cap tech and industrial names showing better participation, and that's a really constructive sign for the broader market health.
Because a rally driven by only 5 stocks is fragile.
It's incredibly fragile. It can collapse in a heartbeat. So seeing this depth is vital.
And yet we have to look at that improving breadth next to the key market statistics in the report, because these numbers are screaming caution.
They absolutely demand caution, and they highlight the risk of just blindly chasing momentum. The S&P 500's PE ratio is at an elevated 27.88.
And the total market cap?
A staggering record high of $57.05 trillion.
$57 trillion. That number alone just makes me nervous. How far above historical norms is that PE of almost 28?
It's not unprecedented, but it's certainly in the upper echelon. It's far above the long-term average, which is closer to 16 or 18. We're not at the dot-com peak of over 40, but we are priced for perfection.
And historically, what punishes valuations like these?
Usually it's one of two things. First, a shift in monetary policy. The Fed suddenly gets hawkish. Or second, an economic slowdown that makes those high earnings projections impossible to hit.
So the implication is clear. High valuations confirm sector rotation.
Yeah.
Momentum is positive, but the market is expensive.
Exactly. It means we have to be surgical. We have to prioritize high-quality names that actually have the structural growth to justify those prices.
Which brings us perfectly to the sectors institutional money is flowing into right now.
And if the market is expensive, you need to know where the conviction money is going. The reserves report puts a huge emphasis on healthcare. It gets a strong, official overweight recommendation.
Healthcare's dominance has really become the story of the second half of this year. Why is so much institutional money pouring in?
It's a story of structural innovation meeting, almost inelastic demand. The sector's performance in November was outstanding, and this isn't some quick trade. It's a long-term thematic shift.
And it seems to be centered around one revolutionary class of drugs.
It absolutely is. Pharmaceutical innovation, specifically the GLP-1 drug class for obesity and weight management, and Eli Lilly, LLY, is the flagship here.
Mounjaro and Zepbound.
Exactly. Their portfolio is getting expanded FDA approvals, moving from just diabetes to chronic weight management. The potential market size for these drugs. Analysts are talking about $100 billion annually.
$100 billion. Well, that explains the stock's performance. Eli Lilly hit a new 52-week high, over $1,000 a share.
$1,055, yeah. And that premium is justified because these drugs are shifting from being seen as lifestyle drugs to medically necessary treatments for chronic conditions. That opens the door for long-term insurance coverage.
So it's not just a one-company story, right? There are other leaders reinforcing this healthcare strength.
Oh, absolutely. The strength is broad. Johnson & Johnson, J&J, is a key anchor. It's benefiting from its oncology and medtech divisions.
Right.
And Gilead Sciences, GILD, is also participating because of advancements in its antiviral portfolio. So when you have multiple large-cap giants, pharma, devices, biotech, all hitting new 52-week highs, like both LOY and J&J did, it confirms this is a structural long-cycle move.
Okay, so now let's pivot to the sector that defined the last 7 months, technology. The NASDAQ Q streak snapped, suggesting rotation, but AI leadership is still central. How do we square that circle?
We reconcile it by becoming hyper-selective.
Okay.
The NASDAQ Q's weak month suggests broad technical weakness. Maybe, the fifth or sixth tier software stocks are suffering.
Yeah.
But the true AI leaders, they're acting like a gravitational anchor.
Like Alphabet.
Alphabet, GOGL, is the perfect example. It gained a stunning 13% in November, all based on real excitement around its new AI chips and the Gemini project. It broke above $300, a new 52-week high.
So the market is punishing general tech, but still rewarding demonstrable revenue-generating AI leadership.
Precisely. AI is still the primary locomotive, but institutional patience for companies that only promise AI gains. That's running thin. You have to prove you can execute.
And then you have Intel, INTC. It surged over 10% on what was basically just speculation.
Intel's surge is a huge deal. It's driven by a single massive catalyst.
Yeah.
The speculation about a partnership with Apple for foundry services.
To manufacture Apple's chips.
Right. And if INTC can capture even a fraction of Apple's foundry business, it's a tectonic shift in its competitive position against TSMC and Samsung. That 10% move tells us that specific high-impact news will still get rewarded aggressively. Makes INTC a priority setup for this week.
Okay, moving to the consumer side. We just got through Black Friday. What did that tell us about the health of the U.S. consumer?
We saw definite post-Black Friday strength, but the data is very segmented. It's a tale of two consumers.
How so?
You saw big winners like Lululemon, LULU, and TJX companies. That points to consumer spending, but they're prioritizing either high-end specialty apparel like Lululemon or value and discount apparel like TJX.
So they're buying luxury or extreme value, but avoiding the middle ground.
Exactly. And the report cited Best Buy, BBY, as the prime example of the challenges in that middle ground.
Right, it fell after earnings.
Fell more than 1%, and they specifically cited weak demand for consumer electronics. So people are willing to spend on experiences or apparel, but maybe they're holding back on big-ticket, durable goods like TVs and computers.
Which suggests a consumer who's being pretty cautious with their savings.
Very cautious. And finally, a quick touch on commodities. We saw a rebound in a few areas.
What's driving that?
It's a dual narrative. First, you have long-term structural demand. Lithium, for example. Albemarle, ALB, is up 25% year-to-date. That's all driven by EV battery demand.
A clear long-term growth story.
Right. And second, you have geopolitical defensive demand. Gold, through producers like Barrick Gold, is participating in a safe haven rally. So even though the equity market is risk-on, big investors are still hedging.
Okay, we get the landscape. Resilient but rotating. Now, what's coming at us this week? Because this earnings calendar for the first week of December is absolutely packed.
It's the single primary driver of volatility for the next 5 days, period.
And for active traders, what does that mean?
It means you should expect severe stock-specific volatility. Overnight gaps, heavy intraday reversals. It's prime territory for what T-KIFE practitioners call gap-fill trades.
Explain that.
When a stock gaps up or down 10% on earnings, it's often an emotional overreaction. So these trades are tactical positions, betting on the stock consolidating or retracing half of that extreme move in the next day or two, all with a very tight stop.
Okay, let's look at the calendar. Tuesday, December 2nd. This looks huge for the tech narrative.
Tuesday is critical for confirming that enterprise IT spending is holding up. First up, CrowdStrike, CRWD, expected EPS of 94 cents.
And this is a Tier 1 recommendation in the report.
It is a core structural leader in cybersecurity. The market will be listening really closely to their comments on cloud security adoption and subscription retention.
And the second one on Tuesday, Marvell Technology.
MRVL, expected EPS of 74 cents. This is a key Tier 12 stock because it gives us a read on a different part of the AI chip supply chain outside the dominant NVDA ecosystem.
So if both CRWD and MRVL deliver.
It validates the confidence in targeted tech names and could potentially reverse some of that NASDAQ Q rotation pressure.
Then we move to Wednesday, December 3rd, and we start with a giant, Salesforce.
Salesforce CRM is a core Tier 1 stock. Expected EPS is robust, $2.86 on over $10 billion in revenue. But the focus here is singular, AI.
AI integration and monetization.
Exactly. CRM has been spending aggressively to embed AI into its platform. Investors need proof that it's translating into real subscription growth. A miss here could hurt the whole enterprise software group.
And Wednesday also gives us that retail contrast you mentioned.
A very stark contrast. You have Dollar Tree, DLTR, expecting a healthy EPS of $1.09, reflecting the strength of discount retailers.
And then
you have Macy's, M, which is actually expected to post a loss, an EPS of negative 15 cents. It just confirms the profound stress on middle market traditional retail.
Then Thursday, December 4th, a focus on staples and deep value.
Thursday is dominated by Dollar General, DG, expected EPS of 93 cents on over $10 billion in revenue. This one is flagged as a potential market mover because it's a proxy for the price-sensitive rural consumer.
So their commentary on inventory and margins will be a big tell.
A huge tell for consumer health. And we also get data from staples like Hormel and Kroger, which will give us direct insight into food price inflation.
And finally, Friday, December 5th.
We finish with luxury personal care through Ulta Beauty, ULTA. They're expecting a high EPS of $4.56. So that'll be the final word on discretionary spending. But the crucial alert for Friday is the weekend risk.
Profit taking.
A lot of profit taking and position squaring. Liquidity can dry up in that final hour, so you have to be ready to lock in your gains safely.
Okay, the report also details the sheer volume of strength we saw last week. Let's quantify that, because the numbers seem to fly in the face of this rotation risk.
The underlying environment is undeniably healthy. On November 28th alone, a massive 302 stocks hit new 52-week highs.
302.
Versus only 52 stocks hitting new lows. That's a ratio of almost 6-to-1. That's indicative of strong, positive momentum where quality names are attracting a lot of capital.
And who are the high achievers on that list, the ones cementing the narratives we've been talking about?
The list is a who's who of institutional focus. You have the AI anchor, Alphabet. You have the healthcare leaders, Eli Lilly and Johnson & Johnson, plus infrastructure names like Broadcom and retail resilience with Walmart. These are the companies driving that $57 trillion market cap.
And the 52 new lows. Any sign of systemic weakness there?
Not really, no. They were concentrated in highly speculative or distressed sectors, isolated biotech, small caps, post-bankruptcy stuff like Core Scientific. It just highlights that risk capital is being very selective.
The market is unforgiving right now.
Very. The strength is concentrated, but the weakness is fragmented.
Now let's talk about the extreme volatility in small caps, because the top 10 gainers list is a wild ride.
It's crucial to look at this section purely for perspective on risk. I mean, you have a tiny company like Security Matters PLC, SMX, jumping an unbelievable 250%.
250% in one day. How does that even happen?
It's almost always a combination of an incredibly low float and external pressure, like a short squeeze, amplified by some small news catalyst. These moves are not structural.
They're symptoms of thin liquidity.
Exactly. And for a prudent trader, it's a vital reminder that these pumps can reverse just as quickly. These are not the high-probability T-KIFE trades we target.
Speaking of which, the most active stocks list tells us where the real institutional money is, where the liquidity is.
The volume leaders define where the safest, most liquid trading opportunities are. Top of the list, no surprise, NVIDIA, NVDA, with over 121 million shares traded.
Confirming AI and chips are still the dominant narrative.
Absolutely. Then you have Tesla, Intel, Palantir, Supermicro, and Apple. It confirms all the activity is centered around AI infrastructure, chips, and the big high-liquidity megacaps.
And what were the most telling moves among those top active stocks on Friday?
They tell a story of the sector rotation in real time. Palantir, PLTR, was down over 5% despite the market being positive.
That's the rotation risk. High valuation software getting hit.
Right. And conversely, Amazon, AMZN, was up almost 2%, benefiting from that confirmed Black Friday strength and consistent AWS cloud spending. It shows that even within that top group, you have to be surgical.
Okay, this brings us to the core of the report. The T-KIFE 20 plus technical analysis and day trade projections. This is where we translate all this into actionable price levels.
Exactly. And we're prioritizing that immediate Monwed window strategy. Short, aggressive, high-confidence trades with a strict negative 1% stop.
Let's start with the longer-term plays first, the top 5 stocks with the best spreads for swing traders.
Okay. These show the most favorable risk-to-reward opportunities the system identified.
And at the top is Pure Storage, PSTG, with a premium RR of 1 to 2.0.
Pure Storage is an excellent data play. That 1 to 2.0 RR means for every dollar you risk, the potential return is $2. The T-KIFE system saw a clear consolidation breakout pattern.
Okay.
The entry target is between $68 and $72 and is targeting a significant 14 to 18% upside up to $88. The rationale is just the strong structural demand for data center infrastructure.
Which directly validates the spending behind the AI boom.
Precisely. Next up is OKTA in cloud security.
A very strong RR of 1 to 1.8.
Right, with an 11 to 16% upside potential. The technical picture here shows the stock successfully retested a critical support level and then reversed sharply on strong volume. That suggests institutions are defending that $180 range.
Salesforce is also on this swing list right before its Wednesday earnings. That feels tricky.
It adds complexity, which is why the RR is slightly lower at 1 to 1.6, but still excellent. The trade here is trying to capture the positive run-up momentum before the report.
So you're playing the anticipation.
You're playing the anticipation with a defined stop to get you out before the actual volatility of the release. It's a high-confidence momentum play based purely on the chart structure.
Okay, now for the highest adrenaline plays. The day trade projections, priority level 1. And the report flags one name with a massive probability rating.
That would be Intel, INTC. It is flagged as the aggressive buy Y with the highest probability 95% for the week.
And that's all based on the Apple partnership news.
The entire premise rests on the momentum generated by that speculation. We are betting on the technical confirmation of that momentum continuing.
I get the catalyst, but 95%, that's a bold claim. How do we know this isn't a bull trap, a sharp rally that just immediately reverses?
That 95% rating is based on the convergence of 3 factors. First, a massive atypical volume spike, confirming institutional buying.
Okay.
Second, the price closed decisively above both the 50-day and 200-day moving averages, which is a rare signal of a structural trend change. And third, our momentum oscillator shows it's still in the early phase of its expansion. It's not overbought yet.
So it still has room to run?
It has room to run. The target range is 30 to 31.50, which is a potential 50 to 20% gain.
That makes sense. What about the market leader, NVIDIA?
NVDA is flagged as a BUY on weakness. We recognize its volatility. The setup shows strong support near $137. The strategy is to enter there, rely on that support, and target 152 to 156 for an 8 to 10% gain. It's a classic buy the dip on a high conviction name.
And Pelletier, PLTR, even though it was down over 5%, is still recommended for accumulation.
Yes. Palantir is an accumulate on dips play. The recommendation is to buy in the $102 to $104 range, targeting 115 to 118. The technical reading shows that dip on Friday was more of a liquidity event, not a fundamental breakdown. We expect a bounce.
Okay, let's wrap this section with the 4 highest priority setups for that short-term Monwed window, the bedrock megacaps.
These are the stocks you trade when you're essentially trading the direction of the S&P 500 itself.
Starting with Microsoft.
Microsoft MSFT is the core AI cloud anchor. The entry is very precise, around $486.07, targeting $493.36. The T-KIFE model sees MSFT as the primary beneficiary of a quality growth rotation. It's the safest AI leader.
Then Amazon?
Amazon, AMZN, the e-commerce plus cloud hybrid. Entry around $221.95, target $225.28. It's built a strong base after Black Friday, and this trade benefits from both consumer strength and reliable AWS spending.
And finally, Apple, the ultimate defensive megacap.
Apple, AAPL, is the defensive megacap growth anchor. Entry at $237.06. Target $240.62. AAPL is the quintessential liquidity buffer. When big funds need growth but want to minimize risk, they park cash here. It's a lower volatility play, but it reliably captures that institutional cash flow.
Okay, we've covered the individual trades. Let's synthesize this into the overall investment strategy, starting with the tiered buy recommendations from the reserve.
Our Tier 1, highest confidence aggressive buy list is focused entirely on immediate catalytic drivers. So the 3 core names are INTC for the Apple speculation.
The highest probability setup.
Right. Then CRWD for critical cybersecurity growth and its upcoming earnings catalyst, and CRM for its AI momentum in that immediate earnings play. These are the ones that demand the tightest monitoring this week.
And Tier 2 is for strong fundamental names to buy on dips.
This is your long-term AI conviction pool, MRVL, NVDA, and PLTR. They represent the indispensable components of AI chip design, manufacturing, software. They're more volatile, so the strategy is to accumulate on dips, not chase highs.
And Tier 3, the sector winners for the medium-term investor looking outside of pure AI tech.
These are the structural leaders that act as portfolio anchors. They provide diversification against tech valuation risk, So that's LLY and J&J in healthcare, AVGO in infrastructure, and WMT for retail resilience.
Now for the counterbalance, the cautious or sell recommendations.
So while we like Palantir long-term, traders who got in earlier should consider taking profits on bounces above $110. That 5% drop Friday suggests there's institutional distribution happening up there. We also maintain caution on Best Buy.
Because of the weakness in consumer electronics.
Exactly. There are just better names in retail right now. And the final caution is on crypto assets.
Bitcoin is down 19% in November.
Right. So for a cautious investor, the advice is clear: wait for stabilization. The T-KIFE system shows no high probability setups in crypto right now, just too much volatility and no directional conviction.
Okay, finally, let's look at the recommended portfolio allocation for December. This sets the strategic weighting.
And this allocation is defined by two major overweight positions, which signals where the highest conviction lies for the next cycle.
Let's hear the specifics.
Technology and software gets the highest weighting at 30%, maintaining that core exposure to AI leaders. But the conviction in healthcare and pharma is immense. It gets a substantial 25% overweight.
Reflecting that long-term innovation pipeline we see with Eli Lilly.
Exactly. And semiconductors are also significantly overweight at 15%. That's driven by relentless AI chip demand. So if you combine tech and semis, you have 45% of the portfolio dedicated to the AI ecosystem, but it's very surgically concentrated.
And the rest is in financials and consumer discretionary.
Which creates a portfolio that leans aggressively into structural growth, but maintains crucial defensive buffers. It's an aggressive approach to an expensive market, but it's diversified against that primary risk of rotation.
So as we enter December, what are the key macro catalysts that could shake all of this up?
It's a two-stage schedule. First, earnings dominate this week, causing stock-specific moves. But the major overarching macro event, the one that will dictate the rest of the year, is the FOMC meeting and decision on December 10th.
Why is that particular FOMC meeting so critical right now?
Because the market is pricing in a very specific, very dovish scenario.
A potential rate cut.
A potential December Fed rate cut.
Yeah.
And if the Fed confirms that path, it fuels the current sentiment and justifies the high valuations. But if they push back, if they sound unexpectedly hawkish,
it could trigger a severe de-risking event.
Immediately.
What are the primary risks in the report that could derail the momentum?
Three main threats. First, AI valuation concerns. The tech sector is trading at historic highs. Any hint of slowing adoption or weaker earnings could trigger immediate and severe profit-taking.
And the second risk goes back to the consumer.
The economic slowdown risk.
Yeah.
We need the reports from Dollar General and Ulta to confirm the resilience we saw post-Black Friday. If the consumer weakens, the whole economy suffers.
And third, that continuing sector rotation.
If the shift from high multiple growth to lower multiple value accelerates, even our high-conviction tech names could see turbulence. That's the risk we manage with the overweight in healthcare.
So to counter those risks, the report ends with strict daily trading rules. These are mandates, not suggestions.
Absolutely. Risk management is non-negotiable right now. First, you must strictly enforce a 3% stop loss below your entry point.
And why 3% specifically?
It allows room for normal intraday volatility, but it cuts your losses before a catastrophic technical breakdown happens.
And position sizing.
Risk no more than 1 to 2% of your portfolio per trade. Do not be tempted to go all in on that 95% probability trade in Intel.
Because 95% probability still means 5% failure risk.
Exactly. Discipline sizing is the key to longevity. And finally, the time stop.
Exit all positions before the Friday close for weekend safety.
You have to. It ensures you're not exposed to unforeseen geopolitical headlines or macro shocks over the weekend. Protect your capital for Monday morning.
So we've navigated the indices, the earnings, and those very specific T-KIFE trade setups. The primary tactical opportunity this week seems to be Intel, but with very tight risk management.
That's the single most actionable catalyst. We've established the market sentiment is risk on, but cautious. And the whole strategy really relies on the continuation of this AI-led megacap trend.
So as the listener looks at their own portfolio and they think about the reserves recommended weightings, especially that aggressive overweight in healthcare and semis, what's the final strategic thought they should be mulling over this week?
It's a structural question. The current rally is built on the expectation of central bank accommodation of a Fed cut. So the core question for you to mull over this week is not if growth continues, but rather if the market fails to confirm that expected Fed rate cut path on December 10th, triggering an institutional de-risking event. Which of the current 52-week high leaders will act as the most reliable liquidity buffer during that inevitable rotation?
Is it the defensive megacap growth of Apple? Or is it the structural, recession-proof innovation of Johnson & Johnson and Eli Lilly?
Exactly. Understanding where institutional cash hides when the storm hits is the key to preserving capital and setting up for the next cycle.
A compelling question to end on as we head into this crucial December trading week. Thank you for this deep dive into the reserve of KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis. That concludes our Week Ahead report for Sunday, November 30, 2025.
We will catch you next time for the analysis in the Sunday, December 7, 2025 edition.